Are we going to continue to have a tough calendar year 2025? To speak on that, I'm going to introduce our next conversation on the show this morning. I'm joined by Amish Shah, Head India Research at BOFA Securities in our studios. Amish, great to have you here and thank you so much for coming in.
My pleasure. Thanks for inviting me.
Yeah. It's a tough market right now. It's a tough market and the pain doesn't seem to be ending on the horizon. What's your view on that? Let me start with that broader point right now. Are things looking a little more murky from here on from an Indian equity perspective?
So Tamanna, I'm sorry to spoil the party, but we definitely are in the bearish camp. Meaning, as you would know, we went negative on the markets back in August last year. And despite the correction, we think Nifty at best is going to return single-digit returns this year. When it comes to mid and small caps, we are still in the camp of them providing negative returns even from these levels. So still more downside.
No, I mean, sometimes you just need, a very clear view. All right, so then what is the positional play over here? I mean, for long-term investors watching this right now, wealth creation opportunities come at bad times. Is this one of them or there is more to go?
There's more to go. So think of it like this, that single-digit returns for Nifty is equal to you making that from a bond market. Yeah. Right? So we all know equities are volatile, equities are risky. If you're going to make a bond kind of a return from an equity, I think you're better off with a bond right now. Fixed income is a better way to do it. And that is as far as the large caps are concerned. And mid and small caps, we argue, will be negative returns. It's best avoided at this point in time.
Wow. Amish, morning. So what is leading to this? Because we've seen, okay, let's argue that there are some internals out here in terms of lack of growth in the last couple of quarters. I believe your notes around Q3 as well paint to a low single-digit or mid-single-digit growth. So earnings are definitely a problem. But I would guess that fund flows out of India, maybe into China, maybe into some other markets are also to be played out here. One question that nobody's been quite able to answer, and I would love to seek your opinion here. What's happening to FI flows? I mean, there is serious outflows. What are client conversations like? What are you telling your clients about where to park the money? And does this money come back at some point of time due to a catalyst, or will we continue to see outflows in the near term?
So Neeraj, for me, this answer is like a pure arithmetic. If you think about it, in the US right now, you can make a 4.5% return risk-free on a US Treasury. Right? So that's your US dollar risk-free return. Add to that another 2% of rupee depreciation that is likely this year, over and above 4% that has already happened in terms of rupee depreciation so far. So 4.5 plus 2 takes you to 6.5. That is arguably your rupee risk-free return if you're an FII investor, right? And on that, you will at least expect another 5-6% of equity risk premium because you're taking risk. It's not safe. So you want at least 11 to 12% returns bare minimum for you to be excited about equities. And on the back of what I'm arguing, that even after the market correction, if Nifty is going to give you only a single-digit return, that doesn't add up to the 11-12% that we are talking about. And if you're talking about mid-caps, we are talking about negative returns versus you can make 11.5% risk-free somewhere else. So logically, if you think about it, why should that money be in India? So I think a lot of people look at it very simplistically, that the FII positioning and ownership is at a decadal low, and that is a reason why the FIIs will come back. That's just plainly wrong. FIIs will go where they can find returns. Given that the returns risk equation in India is right now not favorable, they would probably look for other alternatives, and it arguably is US equities or US bonds at this point in time.
Okay. And your argument for a single-digit return in Nifty is premised on your earnings expectations and the macro situation for FY26. Could something change that, Amish? I mean, I'm trying to understand, because when I read your note, it's clear. You expecting on the back of not a very great FY25, a fairly moderate FY26, right? And I'm presuming on the back of that, you're expecting single-digit returns. What can change that estimate of single-digit return for the Nifty? Let's stick with the large caps for time being.
Sure. So I think, Neeraj, now it is no longer even a debate that India is going through a growth moderation or a cyclical growth slowdown, right? So I think we don't even have to debate that anymore. So logically speaking, anything which is in a down cycle should trade at lower than long-term averages. Arguably, I'm just going by fundamental principles. Nifty, even after the correction, is still trading a shade higher than long-term averages, which basically means that it is very hard to justify a valuation upside or valuation-led upside for Nifty right now. If at all one could argue that valuation should converge to long-term averages and the valuation should continue to come off. In the meantime, your earnings will compound by about 12% in FY26 on a low base of only 5% earnings growth for Nifty in FY25. Right? So basically some valuation downside, 12% earnings growth upside is possibly your single-digit returns that we are arguing. What could turn, as and when the economic outlook, earnings outlook, starts to inflect back towards growth or higher growth, or possibly when the valuation multiples have come to a level where they start looking attractive and that single-digit returns start to look like mid-teens or higher, then I think obviously the equation turns in favor.
I'm just trying to understand, Amish, if it is currency concerns predominantly, or is there something more when it comes to the FII picture? Yes, the currency concerns are there, but then that's across all emerging markets and a whole bunch of currencies versus the dollar. So is there something more that is not visible right now in terms of FII flows?
So Tamanna, first of all, India started with much higher valuations as compared to the EMs. So valuations clearly was a hurdle in terms of a starting point. And as a result, some emerging markets, YTD this year have already done well. India for the last FY21 to FY24, the growth in, let's say, the mid-cap was about 41% CAGR. In the case of small cap was 32% CAGR. That was by far the best growth that you were getting in EMs, and arguably, therefore, valuations expanded as well. Now that we are going towards a softer growth or a moderation of growth, valuations have to readjust as well. So I think India has just gone through a very good phase, and we are now trying to readjust the markets towards what is going to be the sensible growth in terms of a moderate economy that we are looking at. In comparison to that, a lot of EMs, for a variety of reasons, there were concerns on them and they were arguably cheap. And therefore, the money is trying to find pockets where to hide in terms of at least valuation comfort. But, taking that as a bigger point, and, Neeraj was trying to understand on the earnings as well. So look, even now, so let's say FY25, consensus started with 15% earnings growth. We are likely to end the year with 5. For FY26, we think that even after consensus having cut their estimates by 360 basis points, there will be a similar earnings cut going forward by the time you end the year. Logically, earnings growth is going to settle more closer to early double digits, is what our estimates are. When we look at these numbers on a bottom-up basis, we are able to say that 80% of the differential between us and consensus can be explained by 3 C's. We call it lower commodities, lower capex growth, lower credit growth. That is 80% of our growth differential versus the consensus. The remaining 20% is about consensus expecting a very high or a sharp revival in the discretionary, consumer discretionary growth. The growth is anywhere between 18% to 134%, depending on which consumer discretionary pocket you pick up. And each one of these categories, we have our own nuances, but that kind of a growth we think is unlikely. And the final bit is margin expansion. So if you look at FY24, 2/3 of the Nifty earnings growth in FY24 came on the back of margin expansion.
Yeah.
It looks to me that unfortunately the consensus is just dragging those numbers forward and are expecting margin expansion to continue going into F26 as well. But in an environment where for the last 5 consecutive quarters, your top line growth has been in mid-single digit, call it 5-6% kind of top line growth, there is just no pricing power. You cannot expect a company to have lower than GDP growth kind of a top line growth and say that I'm going to hike prices and take margin expansion. So I just think that a lot of estimates, of the consensus are just plainly wrong. And as they become sensible, markets will have to unfortunately adjust to those numbers.
I'm trying to understand whether you see any impact at all of the 2 or 3 things that have happened recently. In the sense, one is RBI's operations, then there was a rate cut, then this tax bonanza to boost consumption. Do you see these factors playing out? Because one theory of what we're seeing right now in terms of moderation of growth is simply that the government did not spend during an election year, and that is now recovering. So if that also comes back into this playbook of what I've just described, do you see that making a positive impact on growth, and then of course the rest of the virtuous cycle continues?
So absolutely, Tamanna. I think government is doing its bit, both through the monetary tools and the fiscal tools. So let's take each one of them. To your point, in the budget we saw fiscal, we saw the tax bonanza of 1 trillion rupees, or about $12 billion. Now that's definitely a positive on a sequential basis. Can it lead to the growth revival in the consumption category? Yes. But when you try to put it into context, right, there are 2-3 numbers that I can mention. That $1 trillion rupees, or $12 billion, is less than 1% of the total retail market in India, including autos. Right, that market is more than $1 trillion. So can 1% additional, lead to a meaningful revival in growth? Unlikely. 1 trillion rupees is also equivalent to 30 basis points of GDP. Is that good enough to stimulate the entire consumption basket of India? Unlikely. Even this 1 trillion rupees is going to come into your pockets very slowly, because it is through a tax cut. Which basically means that there is some saving in your, in your tax outgo every month.
Yeah.
So that is spread out over a month and will be more gradual. Similarly, the subsidies bit, to the low-income households is going to come in the form of monthly subsidy payments. So it will be a gradual process. So the point I'm trying to make is that the directional comment on whether that can help revive consumption growth, yes. The quantum of that revival is not likely to be too high. And as a result, we are not positive on everything consumption in the form of rising tide lifts all boats. We are more bottom-up, more nuanced. We like certain stocks or certain pockets of consumption. So we are positive on autos, real estate, some internet, some travel and tourism theme, jewelry. So there are some things that we like, but I would not say that on the back of the stimulus measures, it will be a big boost to the entire consumption sector.
I'm guessing this would have a large cap bias, and we'll get to the preferred list as well. I know you can't talk stocks, but maybe just the themes. But just one quick question, Amish, on just the macro, right? What would it? I know you mentioned that if the valuations were to correct, then that would make you a bit constructive, or if, as and when the GDP growth numbers move higher. So are we to assume, therefore, and because the markets discount good news 6 months in advance, that at least until September or Q2 of the next financial, the macro situation, ceteris paribus, will not make you comfortable? By then, if the markets start discounting FY27, and if there are things outdone there which make FY27 earnings growth look okay, then you might turn constructive. Until then, the markets may stay flattish to maybe marginally lower as per your current thesis.
So absolutely, Neeraj, so look, everything that we are discussing about, there is no structural problem to India. It is only versus what the markets expect versus what is going to be a reality. And reality, in our minds at least, is going to be weaker than what the markets expect, right? Let me put, so at some point in time, can India become attractive again? Of course, because India is always going to be a structural growth market, and we will always look at the right price to get back in, right? It's just that we are not there yet. Now, let me put some statistic to make sense of this. As I mentioned, that in FY21 to FY24, the mid-cap earnings growth was 41%. That of small cap was 32%. And clearly that growth was much higher than what you can get out of Nifty, which is a representative of large caps, right? So because you were giving a meaningful higher spread of growth as mid caps and small caps in comparison to the large caps, there was a reason why the valuation multiples had to expand, right? Now, if you look at even consensus expectations, mid caps are expected to deliver 17.5% growth over the next 2 years, FY25 to 27, and small caps are expected to deliver 19.5% growth, right? Which is a very small spread in comparison to what your Nifty is going to offer you. For that smaller spread, mid caps are still trading at a 48% premium to the large caps. Is that valuation premium justified? Is what we are debating here. In our minds, it's not, and which makes us bearish. So we think that valuation will have to compress because the growth spread versus a large cap was already compressed.
Got it. Now, the argument against that, Amish, might be that, okay, mid caps is a smaller universe, but the small cap, right, 250 onwards to 5,000, 6,000, what you call, is a small cap space or beyond small caps. And there are a clutch of companies out there. I mean, T&D, recycling, energy, etc., transition, what have you, which are all guiding to very strong earnings assumptions till FY27. And this is after the Q3 con call. We've seen recycling companies, EMS companies, T&D companies talking about very strong earning projections. They've scaled down their estimates themselves, but they're still looking very strong. So my question is, when you are bearish mid caps and bearish small caps, with reason, could there be a large number of outliers simply because a large number of sectors which have gotten created in India in the last 2 months necessarily belong to that small cap universe?
So the short answer is yes. There will always be some bottom-up opportunities to look for. Some of the sectors that you mentioned we don't cover. So I'm not up to speed in order to say whether they are rightly valued or not. I don't know.
Fair call.
But absolutely, anything which is going to offer higher growth would deservedly get higher multiples or valuations and can do well. We are trying to look at mid caps and small caps more on a broader basis right now.
Got it.
The only point I would say, Neeraj, is that this definitely looks to me a year where investors would first look for capital protection,
safety,
returns later, and generally during those times, the money gravitates more towards the large caps. So there may be an element that despite the companies doing better growth, the valuation multiples are still not not to a level where they deserve to be, just because of the risk aversion factor. But having said that, I completely agree that if there are niche pockets which can offer you good growth, they will continue to do well.
Just going through your note as well, Amish, and looking at your perspective on DII flows. I mean, we spoke in quite detail about FIs and what they're doing, but the shock absorbers of our market seem a little shaky as well. Do you think that there could be further contraction in DII flows? Is there any concern in DII flows as well, which is right now the bulwark of what is driving the markets?
So we hope that it stays. But again, if you look at the numbers, markets peaked in September of 24. Domestic flows peaked in October of 24. October of 24 was $8.6 billion of domestic inflows. Okay, if you try to contextualize that $8.6 billion number, it is 2.2 times the average monthly flow between CY21 to CY24. That is arguably the best phase of Indian equities because a lot of retail got into it, plenty of demat accounts. Demat accounts went up by 3.5-fold and so on and so forth, right? So even during the better phase of India, the $8.6 billion is 2.2 times that monthly average flows. If you look at India prior to that, so if I look at CY10 to CY20, so the 10-year period, $8.6 billion is about 4.4x the monthly flows that you used to get at that point in time, right? So clearly the numbers had actually gone up quite high, and $8.6 billion seems to be the peak. Since then, if you look at the numbers of November, December, January, they've been in between $5.1 to $5.6 billion, right? And I would arguably say that, especially in an environment where most of the other asset classes in India are fully taxed, equity still looks okay. Buy the dips has been the mantra for the retail investors over the last 3.5 years. That has made them returns. And on the back of that, the flows have continued to stay strong. So we all hope that stays and retail does not.
That faith is not shaken. I think that's important, that faith is not shaken, and it's been proven, to be rewarded time and again. As we wrap, and I'm sure Neeraj has a point as well, just wanted to quickly ask you that from what you're saying, a defensive play seems safer. You talked about capital protection. So is it the large cap, pharma, FMCG space, which is the best place to hide for cover in your scenario?
So yes, absolutely. So large caps over mid caps, we definitely agree. Within large caps, we are currently within cyclical sectors. We prefer cyclical rate-sensitive domestic cyclicals. So we like real estate, some internet, some autos, financials. This is all rate-sensitive cyclical spaces. Okay. Otherwise, we are defensively positioned in healthcare, telcos, staples. So we have a fair bit of defensive skew to our portfolio as well. And anything to do with capex, we think is still more expensive. So call it industrials, metals, cement, energy, power. We are bearish on all of those.
But that was going to be my last question. We have a minute, Amish, but just wondering. You track, amongst other things, capital goods and the capex so closely. Those multiples and those valuations have come off quite a bit. Do you foresee even the high quality MNC names, which have been the leaders in the last 3-4 years, to actually be under a bit of a cloud?
So, Neeraj, let us put it like this, that between FY21 to FY24, the overall capex growth in India was 20% CAGR, and that was primarily led by central government capex growing at 31% CAGR, state government capex growing at 22% CAGR. You know, so primarily very large government capex drove that 20% growth. Now that the government capex is trying to roll down, as they are trying to balance capex and consumption growth, we think that the overall growth in the capex space is going to come down from 20 to 13. And when the growth overall comes down, it also brings with it margin contraction and working capital expansion. So we think that earlier in a 20% growth era, stocks were budgeting for 25 to 30% earnings growth, whereas in the 13% era, we would have to talk about mid-teens to high-teens kind of earnings growth, and therefore the valuations have to readjust downwards to reflect that kind of moderation of growth.
Well, tempered conversation, and good to take note of a glass half empty situation as well. Amish Shah, thanks for laying it out so beautifully.
Thank you.
That's seriously pleasure, and look forward to having you more often.
Absolutely.